I'm Brad Gould, and with me is Dana Apfelbaum, and we represent two-thirds of the Dean Mead Succession and Tax Group in Fort Pierce. Our partner, Michael Minton, is here as well in the audience, and he's the other third. We'd like to talk with you today because it's a mixed group of people with various technical backgrounds, and we're hitting you after the lunch food coma, so we thought we would not get into the nitty-gritty of complex tax issues, and I hope you'll thank us for it later. We got some applauses. So I want to talk more about some big picture issues. And then we will talk about some of the estate planning issues. And since Dana was an English major and I was an accounting major, I'll talk about the meaning of life and she'll talk about the technical numbers. And we figured that would get us both working pretty well. So when we talk about a business, and I know in looking at the attendance group from here, we have business owners or people who are representing business owners of various sizes. I know we have small growers, we have very large growers. We have large corporations, small partnerships, medium-sized businesses. And at the end of the day, all of you go through this. We have a startup process. You had to start from somewhere. You go through an expansion and growth. Some grow more than others. We have financial stability issues. And then the big one, if we're successful, and ultimately we're all going to die, we go through the transition issues. And that's what we're going to focus on mostly today, on the succession planning, the tax issues that come up with the transition of management, control, and ownership, so that the next generation can continue the business on good footing and not be one of the statistics that we're going to talk about. And I can tell you, all of these issues hit every one of our clients all of the time. And the amount of focus that the successful ones put into this process yields exponential results down the road. So what is succession planning? It is planning for the transition of management, ownership, and control to promote the continuity and future success of a business. It's more than just an estate plan. It's more than someone saying, I've got a will, I'm good. Oftentimes they have a will. Many times it's not a good will. And it certainly was drafted at a time when they were in an earlier stage of this cycle. They drafted the will in the startup phase or in the growth phase. And they're not thinking about, now they're in their 60s and 70s and they're ready for their 40-year-old children to take over. And they haven't thought about it that way. And before that they get to do it, they get hit by the bus or crash, any number of negative things. Sorry, I'm an estate planner. I think in morbid terms, and it's just what we do. So it involves identifying your next leaders, developing those leaders, setting up a well-established governance structure, looking at the business structure. Are we positioned correctly to take advantages of our strengths? Are we limiting our vulnerabilities? How do we govern the family? As Dana's going to go through an example later, does everybody here have the exact same family as everybody else? Or is everybody's brother and sister, mom and dad and cousins different? They're all different. You have to manage a plan for your family. And then there's the financial planning side. That's also part of succession planning because you don't want to set up a situation where you worked really hard all your life and then you're bankrupt at the end because you gave it all to your kids. Kids like you until you ask them for money. So why is this important? 70% of U.S. farmland will be transferred in the next 20 years. Less than 1/3 of family businesses survive to the second generation. Is there anyone here that would disagree with that? How many of you have a neighbor or another farmer where you've just, the torch is passed and it truly the flame goes out? I mean, is there anybody that hasn't seen that scenario before? And it's sad to see. And half of those, that 1/3, 1/6, they make it to the third generation. Yet, 80% of ag owners actually have planned their transfer, but less than 20% have confidence in that plan. They haven't thought through these issues. So to summarize, businesses need help to continue to survive beyond the first generation. Most don't plan adequately or are concerned that their plans don't work, and they don't pay attention, perhaps intentionally, to focus on these issues. Perhaps it's denial. I'm immortal. I'm never going to die. My kids will be fine. They'll take care of it. I've groomed them just fine, but they're not really able to realize the mistakes that maybe their kids aren't able to handle it. And they look at that as a personal shortcoming and don't want to address that issue. Or they also look and said, I'm dead, not my problem. And y'all chuckle. I've had that conversation where, well, let them deal with it. It's, I'll be gone. If they're stupid enough to fight over it, so be it. We'd like to try to help them prevent that. So when you're the issues for transition of management, ownership, and control. And keep in mind, ownership does not necessarily mean control. You can have, and when you're thinking of succession planning, here's the one takeaway. Think outside the box. As a tax lawyer, I often get asked questions, and particularly as a tax lawyer, I always end up giving the one answer more often than I don't want to give, and that's no, you can't do that, okay? In estate planning, it's more often yes, you can. So people don't realize, they don't think about there are many different ways to skin this cat. And every person, every family is different. So don't be afraid. Don't sit there and say, oh gosh, I can't do that. Ask your attorney, ask your financial planner. Can I do this? Don't ask the tax attorney because we're just going to say no. But think outside the box on this. So your goals, what are these goals? We want to minimize income and transfer taxes. We want to transfer appreciation and income during life. We want to generate liquidity to pay for these tax burdens, particularly estate tax, and also for preserving the business. We want to preserve ownership and control from interference of outside parties. Creditors, divorces, in-laws, friends and unrelated partners, Uncle Sam, banks. You want to make sure you can mitigate and control the company from these outside influences. And when I say banks, I mean a bank creditor. Banks are very good. Banks are your friends in many ways. But as creditors, you want to minimize those as part of a succession plan, the impact of them. Maintaining financial security and cash flow for principals after retirement. You don't want that principal who handed off the business to then have to come back and say, hey, son, can I borrow some money so I could take your mom on a vacation? You want to make sure that owner feels comfortable that when they hand over the keys to the kingdom, they still have money to live the way they've always wanted to live and worked hard for 40, 50 years to get there. It's also structuring management. It's selecting the right successors. It's bringing in the outside advisors. A lot of people don't want to do that. A lot of companies don't want to do that. And let me just ask by a show of hands, how many people here are involved in the management of a company that they're not part of the ownership group? Okay, it's a decent portion. How many of you who have family-owned businesses have ever not considered bringing in outside people? So everyone in here is open to it. Good, because I'm going to tell you, here's a conversation we had, and Michael and they know the client, but just try to keep it as without revealing the disclosure. The gentleman calls us up one day and says, I'm dying. You've been bugging me for 15 years to get my estate plan in order. I have to get my plan in order. I looked around at everyone in my family, and he went to his extended family, talking multiple siblings. I want to say there might have been 30 people in the next generation. He said, not one of them has the ability to run this 9-figure multi-state operation. And I brought in outside help, and he never thought he would do it, okay? But he had to think outside the box because he knew if he didn't, it's going to go to hell in a handbasket. And it almost did anyway, because we had some hearse chasers get involved, and we'll talk about fiduciary litigation in a little while. But the point is, think outside the box and structure your management as best for your company. Treating family members equitably. Equitable treatment does not always mean equal treatment. Again, the box is, I've got 3 kids, each one gets a third. Well, maybe they should get a third. Maybe the oldest child is running the business, working the business, putting the blood, sweat, and tears to make that a successful operation, and the other 2 are off, surfing. Do you treat them the same? Do you give them all equal ownership of the company? Or do you say, I got to treat them fairly. Fairly doesn't necessarily mean they all get the same thing. And if you treat them all equitably, maybe your business is going to survive. How do you manage conflicts? How do you manage expectations of the members of the family that want to cash out versus staying in? How do you manage conflicts by possibly among siblings working in a business, but they can't come to loggerheads? It's really easy when there's one person in charge calling the shots. It's a lot different when you are a multi-generation business that has a lot of different stakeholders in there. So setting up a good transition plan and governance structure helps avoid these conflicts. And also maintaining flexibility, because you don't know what's going to happen. And if you did know what's going to happen, there's a $110 million Powerball drawing on Saturday. You don't know what the future holds, so you want to have a structure that allows the company to adapt. And again, that is an important feature of any successful plan. Goals of restructuring: setting up your framework for all future planning, establishing your mechanisms, being able to transfer growth during one generation to the others, isolating your operational liabilities. So what do I talk about? What do I mean by this? So maybe you have an operation where you're hauling citrus. So you got a bunch of trucks. You got drivers hauling the citrus. How many of them do you know are driving sober all the time, are paying attention to the rules all of the time, are not working on 2 hours of sleep, and aren't running red lights and aren't speeding, but they do it anyway, and you've got all your trucks in the same business that happens to own all of your grove land? You've now exposed your land, your most valuable asset, to liabilities from a rogue employee. So it's setting up a plan that isolates those liabilities so you can minimize your risk in different places. You also want to make sure, again, you protect your business operations from outside creditors, the ex-spouses, the IRS. You know, in this conversation, I've been practicing for 14 years now, and I've already been able to see a shift in generational planning where we still have some clients that are, you know, from the 20s and 30s. The idea of divorce to them is almost insulting. And yet all of their kids have gone through it, and all of their kids' friends have gone through it, and the kids are saying, we got to protect this business because I don't know what's going to happen. So we mentioned before, equitable, not equal. One of the most difficult issues to deal with is how to handle the working business and those not working in the business. How do you do that? You incorporate concepts like employment agreements. And again, let me ask you, how many people in here work in a business, maybe they own it or they're not an owner, that have an employment agreement? How many of you actually have written employment agreements? The rest of you need to meet with somebody, because this is a very important thing. How do you control who runs the company? How do you control what they get paid? How do you control what their bonuses are? What happens if one owner decides, I kind of like boating better, I own half the company, tough. I get half the profits even if I don't work. That doesn't sound like a very good deal. Doesn't sound like a very equitable arrangement to me. You can have unequal ownership. Look at buyout agreements. Make sure you have fixed value interest that can be given to family members who are not necessarily active in the business. The partnership freeze can come back, where you give somebody a preferred return where they know they're getting, you know, a fixed percent, but they don't get a lot of the upside. In other words, think out of the box. Managing the family conflicts. The best way to do this is to establish a clear plan during life. Heirs are much more likely to agree when mom and dad are still around, as opposed to fighting over it when they've passed on and you haven't told them anything, and the first time they figure out what's going on is when they see the will. That's not a good plan. Lifetime planning reduces also a lot of issues that are left to fight about. And sometimes you want to think about bringing in non-business owners, corporate fiduciaries, to help manage these conflicts. Banks are great here. CPAs are great. Financial planners are great that have long-term knowledge of the inner workings of the business, where they can advise the new family members on how to handle things going forward. Transition of control. A comprehensive agreement governing ownership is an absolute. Voting control of the business should remain with those active in the business as a general rule. We've got clients like this too, and I'm sure many of you have heard this, where the young brother who has nothing to do in the company, the young sister who has nothing to do in the company, she wants her money. She doesn't care that, you know, you had blight. She doesn't care that there's a drought. She doesn't care that, you know, feed prices are up. She wants her money, and she may not understand the intricacies of your business. And If you don't have control in the right people, that person can really be a cancer inside of a family business and grind it to a halt. So the governing agreements, you can think about individuals versus voting trusts. You incorporate your outside fiduciaries. You have formal structures for appointment and removal of individuals, for removal of people that are not pulling their fair share in operating the company. So with that in mind, which is really the happy stuff, we're going to talk about taxes now. And Daniel's going to give you an overview of income tax and estate tax planning.
Are you going to work the clicker? Okay, we'll start out with income taxes. The fun stuff. You guys are so excited now. As you all know, you pay them every year. The highest rate for income taxes is now 39.6%. And in some cases, you're going to throw on top of that the net investment tax, which is 3.8%. So you're working with, if you're in the top bracket, a collective tax of 43.4% on your income. Specific types of income are the only ones that are subject to the net investment tax. We're talking the things that are not associated with your trade or business. For instance, if you have a ranch and you only use half of the land that you own in your ranching operation, the other half you lease out. Well, the rent payments that come in off of that lease are going to be that passive income that's subject to the net investment tax. So that's your 43.4% taxed income. You also have capital gains, separate type, dividends, things like that are now taxed at 20%. Used to be 15%. And then throw state income taxes on top of that. Across the country, you're looking at rates in the range of 0% up to 11%. And it just depends on where your beneficiaries are or where you're running your operation on what you might be subject to there. However, take a composite number, you could be subject to taxes in excess of 50% on the income tax side of it, depending which state you operate out of, which I think is a good deal more than probably most people would like to give up. Now, on gifts and estate taxes, the recipients of those gifts are not looking at paying any income taxes. However, you do need to think about the estate tax consequences. So, an overview of our transfer tax rules. We have gift, estate, and generation skipping transfer taxes. And they have been reunified since 2011, where you have a $5.43 million exemption this year. It's $5 million, and that's indexed every year for inflation. So next year, it'll probably be a little bit higher than that. Your lifetime transfers, you're looking at being able to gift $14,000 to any number of individuals that you like for tax-free, don't have to file a return, and you can up that to $28,000 if you're married and want to split gifts with your spouse. But if you do that, you're going to have to file the return because the spouse has to consent to it. Transfers on death, I'll call it new because it's new since 2010, 2011, is the portability. So you can move whatever you don't use of your $5.43 million over to your spouse if you make the election on a filed tax return, on an estate tax return, that is. So whatever you don't use, you can give to your spouse and plan on having them, say, have $6 million, $7 million that they can pass outright free at their death. So that's all part of the estate planning evolution that we've seen over the past years, and taxes have been a big part of that. We've seen a big shift from focusing just on those estate, gift, transfer taxes to now being a lot more concerned with income taxes. Again, like what Brad was speaking about earlier, you've seen a shift from family management to more people and more businesses bringing in professional management as things transition from one generation to the next. Direct ownership was the old trend. A lot more people are putting things in trusts and moving towards dynastic ownership. Whereas you used to see a concentrated line of business, just one line of business, now people have moved to diversifying. We've also seen an increase in people being concerned about asset protection, creditor protection, and speaking of creditor protection, we've seen an increase in fiduciary litigation. So a lot of people are more focused on that as they plan on how to prevent that fiduciary litigation. So let's look at an example and just see how this practically works, this shift in thinking. So I'm going to set up an example of B&B Company. Now, B&B Company is owned by Brenda and Buddy. And Brenda and Buddy have 2 kids, Billy and Wanda. Wanda's the black sheep. And B&B Company owns 2 big pieces of property. You have Dead Grove Parcel, which I hate to spoil the ending for you, but is not doing so well. They bought it back in 1970, and they bought it for $50,000. Well, it's now worth $5 million, despite being a non-operational grove. And you have Ranch Parcel, which they bought back in 2000 for $4 million, which is appreciated to $5 million. So they also have some other assets. They have bank accounts, they've got cars, they've got investment accounts, and all of these things add up so that their total estate, joint estate, is at $12 million. And what we are going to do is we are going to apply a discount, and we are going to move to look at what their old estate plan would have looked like under the old regime back in, let's say we're in 2009, which was right before this big shift in taxes happened. Under that old plan, what we would have done is we would have set up a trust which created at the first death a credit shelter trust and a marital trust. And everything that you could, you would stuff into that credit trust as much as you could. The most appreciable property would go there, and everything that was left over, just so you wouldn't have to pay taxes, would go into the marital trust. And we would look to apply a discount. We'd get a valuation done and get as much of a discount as we could, as the IRS would let us take, and that would help us in stuffing that credit shelter trust as full as we possibly could. So for B&B Company, we're looking at taking a 35% cumulative discount. So if you look up, this is what Brenda and Buddy's estate plan would have looked like tax-wise back in 2009. We would have applied that 35% cumulative discount to the interest in B&B Company, LLC, and then it would have been worth $3.25 million, add the $1 million of assets that is Buddy's share of the other assets, and that brings him to an estate of $4.25 million. So with the $3.5 million exemption that was in effect back in 2009, we can stuff $3.5 million into that credit trust, and then the rest of it, $750,000, is going to have to go in the Q-tip. And that's the marital trust. So that means that we have a tentative estate tax of $1,455,800. But because we have the credit and because we put the rest of it in the marital trust, we're not looking at paying any tax on Buddy's death. Move over to the death of Brenda. Brenda's got her own estate. Picture it looking exactly like Buddy's did, except she's also got the $750,000 that was shoved in the Q-tip so that they wouldn't have to pay tax on Buddy's death. So she has a tentative estate tax that is $2,130,800, which puts her just above where she would be able to get off without paying any estate tax. So she's going to owe $675,000 in estate tax, or her estate is, rather. So after death, what are we looking at? We're looking at here where Buddy's assets were $3.5 million that he passed tax-free, and Brenda's assets collectively $4,325,000. Right, on a discounted basis. I'm going to put the mic back up here. So we have gotten away between the two of them, passing $12 million of assets at an effective tax rate of 5.625%, which is a pretty good deal. I don't think that there was anybody who was upset about that. And there were really only 2 big drawbacks to such a plan. One being that you didn't get a step up in basis, which means that since they didn't own it outright and you got that wonderful 35% discount, you didn't get a full step up into, say, like what each of the parcels was worth, which if they had been owned outright, you could have gotten. And the other downfall to the plan is that they didn't think about the fact that Billy and Wanda are now tied together. They have a trust that has been created for their benefit. And they have put Billy in control of the trust because Billy's the one running the business. But Wanda, as Brad mentioned earlier, is off surfing. She's a bohemian. She's not involved. Or maybe now she does want to be involved. She's always desperately wanted to be involved, and she never had the head for it, but now she's trying to push her way in. So either way, it's putting a lot of pressure on Billy. And he doesn't have as much time to do what he actually would like to do and which would be best for the business, which is to run the business. So there are some drawbacks there, which, you know, as Brad touched on earlier, you can involve some of the new schemes to take care of. Maybe you want to think about bringing professional management in a situation like that. So now we're going to move on to see what it looks like after death. And you've got a sale of Dead Grove Parcel. It's not working, so we're going to sell it. So what's happening here is we are going to make a 754 election. A 754 election is an election that you can make upon the death of a partner or upon the transfer of a partnership interest that's going to bring into parity the inside basis and the outside basis. So what the basis of the assets are inside the partnership and what the basis of the partner's partnership interest are. And it's going to make adjustments just for that one interest in order to bring them into more of a parity. So here, when we make the 754 election, what you see is that Buddy's basis is adjusted up to $1,044,200. So you have saved, if you look at Brenda's basis, which was $25,000, which is what Buddy's would have been beforehand, you've saved about $1 million of gain. So Buddy is going to generate on his interest a $218,000-ish tax. And on Brenda's interest in Dead Grove Parcel, you're going to see a $371,000 tax. Collectively, you've paid $589,620 in tax, which seems like a big number, but that's okay. We're okay with it because we're in 2009, and we just saved a boatload of dollars on estate tax by taking a discount. Because if you hadn't taken the discount, you would have paid about $1.7 million in estate tax. So when you think about it that way, paying $500,000, $600,000 in income tax seems pretty okay. Now, what you need to remember about a 754 election is that after seeing that, you're going, oh, great, everybody should make a 754 election. But while they are wonderful in the right circumstances, you do still need to consider that a 754 election does not always result in an adjustment up. It can also result in an adjustment down, which people are surprisingly less enthusiastic about. So you have to really consider what the facts and circumstances are for your particular case and determine, consulting with an accountant, with your attorney, whether the 754 election is right for you. But it is something to think about, particularly on the death of a partner, as to whether it's something you should be doing. Now, also something else to bring your attention to is that with the net investment tax that I mentioned earlier, we've sold Dead Grove Parcel. As long as we have not converted it to an investment asset, we're okay because it was used in the trade or business years ago. But if you've converted Dead Grove Parcel to be something of an investment asset, then you also need to be concerned about adding that 3.8% tax on top of it, on top of the tax that we talked about. So let's take a shift over to the new estate planning analysis and what it would look like today under 2015 regimes. You've still got your credit shelter trust, you've still got your marital trust, and probably, a lot of people are still working with estate plans that have these old provisions in it. They were done before the change in tax regimes, and that's okay because there's still planning that can be done. But now we're also looking at those plans, and in addition to thinking about whether a discount is appropriate and how things are going to work out between the credit shelter trust and the marital trust, we're also thinking about income taxes, about capital gains, and about that net investment tax to really determine which way we go. It's just added another layer to the analysis. So now looking at what Brenda and Buddy's estate plan would look like in 2015, this is what it looks like with the discount. So you see, with the discount, at Buddy's death, you've got the same $4.25 million. And that is, wonderfully, below the $5.43 million exemption. You're not paying any estate tax on Buddy's death, and you don't even need to fund the marital trust. So all of that is going to continue to pass tax-free throughout generations. Then on Brenda's death, because she doesn't have that bump up from the Q-tip, from the marital trust, she's not paying any estate tax either. In fact, her assets could appreciate by about $1.8 million before you'd even need to be concerned about paying an estate tax. So while paying no tax is wonderful, you're also missing an opportunity here. And that opportunity is layering in what we call basis planning. So for basis planning, what we are looking at is really taking advantage of being able to have that step up in basis and take advantage of that and not have to take the discount that puts us in a position where maybe we're having more to pay in income taxes later, which makes a lot more sense when you actually look at the numbers. So we've set up a scenario. So now we're looking at how do we get there. So think instead if when Buddy's terminally ill, we find out that Buddy is terminally ill, what we do is we distribute Dead Grove Parcel out to him. And maybe we distribute it to his revocable trust, which is the partner, or maybe we distribute it into an LLC that's 100% owned by the revocable trust, which is much better for creditor purposes and asset protection. And that leaves Brenda with B&B Company, with Ranch Parcel still in it. She's making gifts to Billy. Maybe she's taking care of Wanda some other way, life insurance, who knows. And then Buddy owns Dead Grove Parcel with a $2,025,000 basis in it because that is his outside basis. So he's limited to taking his outside basis, which again is his basis and his partnership interest. So he's limited, but we are about to see a big step up because, as you remember, Buddy's terminally ill. And when he dies, we are going to be able to step up his basis in Dead Grove Parcel to $5 million, which is how much it's worth at the time that Buddy dies. So now, Buddy's Credit Shelter Trust owns an asset with a $5 million basis and a $5 million fair market value, which is pretty good if you're thinking about selling it. So when they sell that property, they're not going to realize any gain, and you have left Brenda with a regime where she is able to dole out what's left and minimize income taxes, as well as taking advantage of the estate tax no-pay scheme. And now I'm going to turn it back over to Brad to talk about some other things.
So in the end, we've eliminated the estate tax through this type of planning. It's a very basic example, but it really sets up what the new paradigm is how do we plan for death and focus on income and basis planning. Nobody wants to pay estate tax, but sometimes messing around with the estate tax and paying a little bit yields exponential dividends on the income tax side. And so I'm going to go through a couple of just different examples just to see the basic concepts of how these things work for you to take back to the office or to go talk with your advisor. So when we refer to Q-tip, this is the marital trust. We call them Q-tips. Sometimes they're called AB trusts. We have this situation where a husband dies, he's worth $5 million. We have the typical plan. When I say typical, this is what you used to see. Everything to the spouse. I love you wills is what we call them. So I love you wills, or I love you, but not enough to give you full control. I love you enough, but put it in trust. So here it goes in a marital trust, $5 million in 2015 when the husband dies. If we assume a modest 2% inflation rate, the wife also has $5 million. When she dies 10 years later, her estate's worth $8 million. That marital trust is all included in that wife's estate. So when she dies, the husband dies, no estate tax, full step up in basis at wife's death of the whole $16 million. We use what's called the DSU amount. This is what Dana mentioned earlier, where since the husband died, we didn't use any of his credit. All of his credit is available when the wife dies. So he had a credit when he died of $5.4 million. We're assuming 2% inflation, credit of $6.6 million on the wife's death. So you have a taxable estate of $3.95 million and a $1,580,000 estate tax. Doesn't sound very good. It's a 10% tax rate, which when you think about 40%, 10% isn't too bad. But this is not ideal. Okay? Now, just as an aside, particularly for farmers and closely held businesses, this $1.5 million tax might not necessarily be due right away. Normally, an estate tax is due 9 months after somebody dies, but if you have qualifying farms or you have qualifying closely held businesses, the payment of this tax can be deferred for 15 years at an incredibly low interest rate. It's called a Section 6166 election. So we often use these in qualifying circumstances to mitigate this large tax bill. And even if you have the cash to pay there, if you have a decent financial planner, they probably can earn a better rate of return net of tax on the money that you have, so it's like a cheap loan from the government. And also, depending upon the nature of the business, and if we go back to Brendan and Buddy, they'd probably qualify for what's called a special use valuation under Section 2032A, further reducing the potential tax. So the garden variety plan was what we would call the AB trust, a credit shelter marital trust, which we talked about before. And here's how it would work under these numbers. You'd have the $5 million of the credit trust funded by the credit trust. So now the husband dies, worth $5 million. All of his money goes into a credit trust. Still benefits the wife, but it's considered outside of her estate. What happens is when the wife dies, this credit trust assets do not get readjusted. You only get a readjustment to fair market value when the assets are included in a decedent's estate. So in the prior slide, all of those marital trust assets actually get included in the wife's estate. You get a full step up in basis. If they liquidated right after the wife died, there'd be no income tax. On the other hand, when you use a credit shelter trust, when the wife ultimately dies 10 years later, the basis does not get readjusted, okay? So now, wife dies, she's worth $8 million. Husband didn't fully use his DSU amount. It's $430,000 of his credit available. So the wife dies, the estate tax is now $380,000. To go back, before we were at $1,580,000. Now we're at $380,000. That's a pretty good savings. However, if you liquidate right away, wife's estate has no estate tax. Has no income tax because its basis is equal to fair market value. But those husband's assets that are in that credit trust, they have a basis of $5 million. So now, if you sell them for $8 million, you're going to have a gain, 23.8% if we're just dealing with federal tax. That income tax is another $714,000. In these facts, it's still better going this route than dealing with the estate tax route where you're paying a full level of estate tax. But we can certainly come up with scenarios where the income tax side is a lot worse. Go much further down the road where there's a lot more growth on the husband's side. Maybe he was, was it Marshall, the guy that married Anna Nicole Smith? And there's a good 60-year gap or 40-year gap between them. This number can be a very different number, okay? So the planning options, when dealing with this, postmortem And deathbed planning becomes vital. And again, as morbid as that sounds, if buddy's, the husband is on death's door, you got to think about planning for the estate tax. Can we get these assets that have great appreciation out of a combined group and just in a buddy's name? Can we shift assets around between the spouses? Do we need to harvest losses by selling properties that have significant losses in them? Even if we want to keep them, maybe we go back and buy them later. But if you don't do that, then you're going to lose basis adjustments. So we look at things like the bypass and marital amount, and inside that those estate planning documents, we look at different funding formulas to find what's the right mix. And I'll tell you, and I was joking around before about the Powerball ticket, in some ways it is a crystal ball, because if you could really foresee exactly what's going to happen every step of the way, buy a lot of lotto tickets, okay? But you do your best. You try to structure a plan that's as flexible as possible, and then you have to be proactive with your tax advisors every step of the way. And that plan that you set up when you were starting up, that plan you set up when you were in growth mode is going to be a different plan that you're set up when you're in transition mode. Some of the other things that we do, and this is just a little bit of technical wonkiness, is we can put some things inside a trust. We call them powers by a disinterested trustee. So one of the ways that you get a step up in basis is by including an asset in somebody's estate. So maybe you set up this trust. The will says, when I die, Buddy and Brenda say, put all of B&B Company in a trust for Billy's benefit. Well, you say, great. You got a basis step up when Buddy and Brenda died, but now Billy's there with this trust, and when he dies, there's no basis step up. Well, you can put a mechanism inside of a trust that gives somebody else the power to give Billy the power to cause the assets to be included in his estate. And you keep that external person involved, that advisor, who could then trigger that power if necessary. I realize I'm talking very vague terms. I just didn't want to bore you with the specifics. But the point is that these outside investors who know the business, who know the family, can be involved and make financial decisions without the emotional attachment to them. And this is one way of getting your basis step up. And I mentioned earlier, you have a sale of lost assets. Very briefly, we have about 5 minutes left. We have to do some tax planning, and the tax is in the name. And I understood this morning that Professor McGowan talked about conservation easements. And I just wanted to talk a little bit about them as a planning opportunity in the estate planning world. So I'm going to go a little bit faster through some of these because I understand you had a class on it this morning. But assume the St. John's Water Management District wanted to buy a conservation easement on a portion of that ranch parcel. It's 2,000 acres, and conservation easement will restrict all activity on 250 of those acres for $1 million. The conservation easement will encumber the balance of the property with a flowage easement that allows any type of farming activity but no further development. And let's just say, kind of not realistic, but let's say the flowage easement's $250,000. So in selling this conservation easement, I know the tax issues were discussed earlier, so I'm not going to get into them. But one thing it does is it depresses the value of the property. Okay, so in addition to getting your, a relatively low income tax on the sale of the conservation easement, the flowage easement is only going to result in a reduction in basis, which shouldn't generate a tax. Property taxes go down, but you've also depressed the value of that parcel. So if you're in somebody who isn't in Brenda and Buddy and Brenda's shoes, where maybe they're worth 15 or 20 million, this conservation easement, they get some cash today, they pay some sales or capital gains tax today, but they get to reduce significantly the value of their estate. So there is some estate planning opportunities here. They're also good for donations. So maybe that they have some charitable intent. If they're thinking about making a donation of a conservation easement, doing it during your lifetime, you get an income tax deduction. If you hold it for longer than a year, you get a very good income tax deduction. And then you get estate tax deductions on the back end. So the conservation easement, again, for high tax estates or charitably inclined estates, a very good tool to use to help reduce your overall tax. So with that, just want to say that the takeaway here is plan. Think about global picture. Don't be afraid to ask the questions. Don't be afraid to say, that's not how the guy down the road does it, but maybe that's the right thing for me. And just think outside the box. And with that, we're done.
All right. Thank you very much.